So today we have two advisors, LPs that are in our fund, and they are going to be Angelo Del Duca, which hopefully the community is quite familiar with, as he has been a supporter and part of our business for almost since it started. So thank you, Angelo, for being here today. And of course, Jeff, who we just gave the introduction to. Both you gentlemen, thank you very much for attending and being part of this today. So the way the process will work today is there will be 4 companies that will be pitching, and they will be providing a 5-minute pitch. And then Angelo and Jeff will provide 1 minute each of feedback for that company.
So in a nutshell, what is Levion Partners? We are looking to buy a business from a retiring owner, grow it by 10x or more, and exit the business in 4 to 7 years. The business we seek to take over must generate at least $2 million in net profit, or EBITDA. That's Levion Partners in a nutshell. So the big question is, how many business owners, older business owners with big companies are retiring? Well, quite a few. The market size for acquisitions is over 16 billion. And that's only the businesses that fall into our range in Canada. We're not talking globally, we're talking about in Canada, businesses with 20 to 100 employees. That's about 58,000 companies. And there's a lot of BDC research on that you can look at. It's actually, quite a big issue with all the baby boomers retiring. In terms of competition, there are about 20 to 30 other teams we know of in Canada trying to do something similar to us. Similar story, younger teams seeking acquisitions from retiring founders. One differentiator is that me and Elvin are both, while we do have a lot of sales experience and management experience, we're also programmers by trade. And that lets us actually transform this company to a technology company, in addition to just, souping it up in other ways. Now, what do these companies look like? The ones we acquire, the average purchase price is about $10 million, sometimes a bit more, I'd say, for ones we look at. This is based on a research paper done by Stanford, which actually looks at younger teams that are going to acquire retiring founders. And that's about 4 to 10 times EBITDA. Now, you might say, hey, startups sell for far more than that. But again, these are often very traditional companies, accounting firms or, software which might be older, that needs to really be rejuvenated. So that's why the EBITDA here, when we acquire it, is a little bit lower. Now, why does it work? Because basically we're adding young blood and energy to an old company. Often the owner is, even a senior citizen quite often. And in fact, 37% of Canadian business owners who have 20 employees or more do not even want to grow their business anymore, according to the BDC. And that's really, at that age, they're looking for an exit plan, and they have, personal values that they may want to invest more time in rather than growing the business. And 10x return is quite common. Again, Stanford, you can take a look at the research. They did research on, younger founders buying out from older founders. And there's a 10x return on average and an average IRR of 34%, which is quite high. Now, what will this look like? I want you to help visualize it. So sort of beginning with the end in mind, imagine acquiring a $2 million EBITDA accounting firm. Well, we'll transform that into a fintech via, say, automating the bookkeeping and various other things. Then now that we have our spurs on, we've got some good tech, we've got some good AI there, it's time to also continue acquiring further accounting firms and applying that technology. Again, when we exit, we really are looking at these 3 pillars in terms of maximizing our exit valuation, right? So 1, organic growth. We want to be able to grow this company just naturally the way it is. It should be naturally growing by just doing, investing in sales. 2nd, the valuation. We're going to transform this to a tech company. So now we're selling for a higher multiple, right? Not the 4 to 10, hopefully a higher multiple than that. And finally, by acquisition, we're going to acquire more firms like it in order to, grow by acquisition. So we score each potential company basically based on those criteria as we find them: organic growth, valuation growth, ability to transform it, and growth by additional acquisitions. Now, some noteworthy backers. We have a lot of interest. So Tushar Shah is the managing partner of Counterhook Partners. They're a U.S. private equity firm. Previously was a VC. George Yankovic, he's a great backer and mentor. He did what we'd want to do. He acquired Nutrisystems and grew it from 20 million to over 600 million in 3.5 years. So he's mentoring us and on board for investment. Now he basically invests in conducting private buyouts. And then of course, these aren't small deals, they're very complicated. You really want somebody who has experience in doing them. So Mario Negro is our lawyer in Toronto, and he's done a lot of deals like this. And again, he's actually an investor as well. Quick timeline. So this is just sort of a timeline of how we're going to get to that valuation and exit. In the first 120 days, we're going to build some core KPIs with all the stakeholders, customers, employees, and mentors. Then we're going to increase our lead generation, which is a place where a lot of these older businesses don't focus as much anymore. Add digital marketing. Many of the companies we found just don't even do digital marketing. Optimize price, and then within 120 days, we want to get out some technology that will give us an edge. About 1.5 years later, we do our first additional acquisition, and then we'll do another 1.5 years later to grow that company, and finally we exit. And the green line there is sort of the company valuation as we see it increasing over time. So a bit about us, just briefly, Alvin was a director at Sun Life. As part of a team, he oversaw about 20 billion in public debt investments, so he's great at evaluating companies. In terms of myself, I'm a former senior line of business manager at IBM, so I was end-to-end accountable from development to sales, and I'm a cloud architect by trade, and my last company was acquired by NASDAQ JCOM back when I did a startup quite a while ago. And our investment ask is, we already have some funds for the seed, but we have 340K remaining, and that basically goes to do the daily work, to vet the company, due diligence. These are big companies, we need professional accounting firms, and again, the cost of the acquisition. For the second round, once we buy it, we actually have US private equity firms sort of in place for that acquisition, so our funding is mainly for the seed round. Use of proceeds, this is just the final slide, and it shows the breakdown of what we're using it for. So we have a principal draw, nothing unusual here, a lot going to due diligence and that sort of thing. And that's it. We're very excited, so thank you, and please reach out to us for questions.
Perfect. Thank you very much, Simon. That was great. And I'm going to add Angelo in. Angelo, you're good to go.
I'm good to go. Thanks a lot, Simon. I understand the problem that you're trying to tackle. A couple of years ago, I actually led an acquisition of a company which, from an investor point of view, probably wasn't all that exciting, but from a lifestyle business was amazing. And they were old school, and I saw the acquisition of transforming an old school company into a new school model as being a vehicle to really fuel growth. So I understand the problem. I think that there is an opportunity there for you, and probably what I would like to see is beyond the minimum metric that you identified, 2 million in EBITDA as being the target marketplace. But possibly focusing on particular sectors initially, and then growing as you grab more and more sectors into the business model and fueling your growth. So possibly a better handle on your roadmap in terms of growth would be very helpful. One feedback, clearly you are focused on exiting, right? Exiting your companies, which in turn will help an investor exit his or her investment in your company. But in that framework, I'd like to have better clarity on the use of funds. The thing that caught my eye in your slide was there's a good chunk of money being allocated to salaries of, in particular, the founder. That usually doesn't have a lot of real appeal from an investor point of view. So I would rethink the use of funds and maybe have it a larger emphasis on growth from the perspective of marketing, sales, and analysis. But I may be a little bit cruel there because you only had 5 minutes to go through with that. Other than that, I like what you're doing. So good job, Simon.
Great, thank you.
Thank you, Angelo. Jeff, you're up.
Simon, good presentation. Hit very close to home for me because I've basically done that, exactly what you're doing. I've bought 2 different businesses from retiring owners, built them up and sold them. Basically did it on my own, did not involve partners. So I get it. But to be honest, then on the other end of it, it raised two big questions. So basically your presentation, I really don't have a lot of comments or anything on criticisms. So I thought it was very well presented. The two things I think when you're going to be pitching to angel investors anyway, specifically, that you'll want to focus on, one will be basically you and your partner each have a certain skill set, okay? And one thing I've certainly learned is just because I have a certain skill set, but that doesn't mean I can buy any particular business and run it and turn it around. And angel investors that are sitting there, a lot of them will have done the same thing. They're going to know that too. So I think you'll either want to give angel investors the confidence. So basically, you know, if you guys have an accounting background and you're just looking at accounting firms, or, you know, your backgrounds are very, like, what type of companies are you looking for? Like, if you guys were looking to buy an automotive parts company, I'm not totally convinced, even though it might meet those financial metrics, I'm not totally convinced that you would know what you are doing to run it and grow it. So I think you might want to give a little more clarity and pitch on the confidence that you can buy and run and grow the type of companies you want to do. And then secondly, I think the term sheet's very important here, because like I say, again, knowing this, you're gonna buy it, grow it, and run it. It's a good opportunity for you guys, especially looking at your metric slide, to make some money. As an investor, I sit there and go, well, I'm not totally sure because I haven't really seen the term sheet. As an investor, you know, you're pitching a great idea, but how am I going to make money? Are you looking to sell shares? Are you looking for a loan? Are you looking for a convertible debenture? You know, sometimes in a case like this, you know, maybe just coming out and saying, you know, we're going to do this. We want a loan of $1 million and we're going to pay 18%. And something like that, I think in your case is going to excite a lot of investors, only because, you know, I've done some other side deals with that on buying and turning around companies. We have loaned money to these type of companies at a high interest rate, on a well-written note, and, you know, it generates some good money for us. It excites us pretty easily. So that is something you might want to consider. But as I say, just like I say, good presentation, but just because, you know, this really is my wheelhouse, those two things I thought, you know, need a better explanation, because those two questions just kept coming up to me. Do these guys really, either you have a specific business in mind, which you didn't mention. I know your example was an accounting firm, but in general, you sounded like you were kind of looking open to any company. Well, I know that you guys, and not you guys specifically, but in general, you can't just walk out there and buy any company without the expertise. So how would you get it? And then, like I say, you're going to have to be creative on a term sheet to convince the investors that they'll make money. Other than that, like I say, fantastic. I'm certainly interested in talking more.
Great, sounds good. That's really good feedback. Yeah, we do have some industries specific to just to address both those concerns, but yeah, we'll have to make sure that's more clear in the pitch.
Sure.
Thanks. This is really great feedback.
Okay, good. Thank you.
Perfect. Thank you very much. Simon, thank you. So I guess just to kind of pull back on that, I think some of the things you want to be able to clear up just a little bit is on the roadmap of growth and where you're going to be able to tie in the value proposition. I think some of this stuff we've talked to a few times, but certainly putting together the background of where you guys fit and where these companies are that are going to be the best type of acquisition. And if that means that the monies that you are raising are going to go back to bringing in different consultants or different partners that are going to come into your business, and then how the dividends and warrants would work over that time period as you do have investors come in. So a few extra little things to bring in, but great job, and thank you very much for that.